have some viewer mail.
And I'm very happy about that.
So Richard writes in, I've recently discovered your podcast and I'm enjoying it. Thanks for putting it out there. I'm puzzled about something you mentioned in your August 26 podcast. I don't understand why printing money will fail to stimulate an economy. If a government is not worried about inflation or currency devaluation, why not wish some more into existence and spend it as a tax cut or stimulus?
Great question.
Thank you.
First, thank you for the compliment. I'm very happy that you like our podcast and you're watching it. I'm not happy you're puzzled, which is why I want to answer this question for you, because if you're puzzled, someone else is puzzled. I'll take this in different segments, so let's start with the beginning. I don't understand why printing money will fail to stimulate the economy. I hope I didn't give everyone that impression. What I was trying to say last week was that printing more money will not likely stimulate our economy very much. We've already printed $1.5 trillion, and that seems to be plenty. We've put a lot of money into the system. Interest rates are extremely low. Banks have plenty of money to lend if they wanted to lend it, and companies' balance sheets are flush with cash.
And they're holding on to it.
And they're holding
right
on
now.
to it. It's not like somebody doesn't have any money out there. So my point in monetary policy and not printing more money wasn't that in general printing money isn't stimulative. It is, but printing too much of it, there's a declining value in printing too much, and eventually you've got to unprint it. You've got to destroy it. So that's the first thing. The second thing is, if a government isn't worried about inflation or currency devaluation, well, the government would like to see inflation now. So it's definitely not worried about it. We want to see inflation. It's a goal. And currency devaluation, we're always worried about currency devaluation. Everyone is. It's just that you can't handle everything at once. So if you want stable prices and high employment, which is the two main mantras of the Federal Reserve and of most economists, if you have those, well, your currency is going to move independent of that, and it's really hard to manipulate it as well. And in fact, we shouldn't manipulate it at all.
Quite the balancing act.
Right. So if those aren't concerns, why not just increase the money supply and spend it as a stimulus or tax cut? So to answer this, we have to make sure we're clear on the difference between the Treasury and the Fed. So let me do a quick diagram to see if I can explain the difference clearly. Treasury and the Fed are two totally different entities. The Treasury has the ability to tax to increase revenues, and they can borrow. And when they borrow, money comes in and they give you paper, which is basically Treasury bonds, bills, and notes. So there's two ways for money to come into the Treasury so the government can spend it, is through taxation, which we're all familiar with, and of course through borrowing, which we're also familiar with, and then the Treasury can spend it. To get the money into the Treasury, they have to find somebody to borrow money from, which are investors. So we have
China.
Yeah. In China.
To name a few.
So investors give their money to the Treasury and they can spend it, and then they get back bonds, bills, and notes, and they get interest on those, and they're basically the risk-free rate in the investments. So investors are usually banks, and they can be, as you said, China, Japan are their two largest creditors. Both are $800 billion or more of our debt, and then many, many other countries, as well as you and me. A lot of people have treasuries in their portfolio, a lot of pension funds, insurance companies. A lot of people have treasuries in their investment portfolio, and that's basically loaning money to the government. So that's one way that we could increase stimulus, is to borrow more money from whoever and spend it, which is either a tax cut, which means in tax cuts, we simply reduce tax revenues, increase borrowing so we can spend more money. So, tax cuts mean more borrowing. So make sure we're clear on that, right? We can't cut taxes because we don't have more money coming in. If we have less money coming in, that means we have to increase borrowing. Yes. So tax cuts equal more borrowing if you want to spend more money. So the banks are the investors sometimes, and the Federal Reserve usually deals with the banks to increase the money supply. So they give the banks money, and the banks in turn give them treasury bonds, usually treasury bills, short-term securities, but they can go up further on the yield curve if they want to. And in addition to that, we've been recently buying mortgage-backed securities. Over the big financial crisis, we bought like 1.3 trillion. I think it's 1.3 trillion of them. So we bought a lot of mortgage-backed securities. That put a lot of money into the system. If you think about it this way, if I used to hold a mortgage-backed security and I sold it, I have money that I could do anything I want with it. I could spend it on movie tickets, or I could invest it in treasury bonds, or I can do whatever I want with it. So it put a lot of money into the system. The problem is nobody took that money and spent it. They invested it back into treasuries and other safe things because they didn't want to lend it into risky things. So banks, even though they have a lot of money, didn't loan it out to you and me, which would be spending. Because when you get a loan, what do? You spend it. If you get a loan for a house, you spend it on a house. If you get a loan for a business, you spend it on equipment and employees and so on for the business. So the Federal Reserve can print more money and go into banks, but banks are flush with money. There's plenty of money in the banking system. If they need it, they can get it. There's no bank that is like all of a sudden they're
holding it back.
They're holding it back. They're not lending it out to people who will end up spending it. They're investing it into treasuries for the most part, or not necessarily the most part, but
which don't really have a very good return right now.
Well, they don't have a very good return, but they're very safe. So the banks are skeptical of lending money out into especially the small business. They'll lend money to IBM because IBM's not going under. But
if you don't need money,
they're
ready to loan you all you want.
If you're the restaurant down the street that has the need for a new ice cream machine or whatever you need, it's probably harder to get money than it is IBM. So in answer to your question, why don't we just print more and do more or cut taxes or more stimulus? One of the things is we would have to go through an intermediary, which in our history has been China and Japan over the last 10 years or so. So we're actually bringing other people into it. And then eventually that spending or that tax cut has to be paid for. So we're paying interest on it. So it's very important you discern that there's a big line between the Treasury and the Federal Reserve in that the Fed has to increase the money supply. They have to go out and buy existing instruments. The Treasuries can introduce new instruments, but there's an intermediary through a bank or through another entity that's involved here. So the Fed increases the overall money supply, and the Treasury is just one part of the overall economy that borrows and spends. Actually, they tax and borrow and then spend. So it's not as easy as just print more money and we have more tax cuts. We actually print more money, pay more interest to whoever we're borrowing it from, then we can have more tax cuts.
We don't need to do that. We don't want to increase our deficit, do we?
Well, the scary thing in here is we've already borrowed so much that we're kind of like teetering on borrowing too much. And someday somebody's going to say, you know what, your credit isn't good anymore. And when we're borrowing now at, what is the 2 years at like 0.5% in the Treasury? It's like 0.5% for 2 years.
Yeah, that's cheap money.
Yeah, that's cheap money. Well, Greece isn't 0.5% for 2 years. It's more like 12%, and it's been as high as 22%. So imagine paying interest on a 22% loan as a country like Greece. Well, that
would not work.
That would be skyrocketing to the poorhouse. So, we don't want to just cut taxes and spend, because eventually we have to pay that bill. So while we can increase the money supply from the Fed, they can print money and they can buy bonds, but they can also do the reverse. So when they want to decrease the money supply, what do? Well, instead of spending money and buying bonds, they go out in the market and sell bonds. They do exactly reverse, and they take money out of the market. So the Fed can put money in and take money out. The Treasury, once they issue the bond, they have to keep paying interest on it until it renews. And of course, since we don't have a savings program, we're continually borrowing, we need to continually roll them. So it's not as easy as just increasing the money supply and spending like crazy. That would be a little too easy, I think.
And what's the takeaway here?
So the takeaway here is spending and tax cuts are completely separate issues from money supply, and it's very important that you separate the two.